For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. The stock market has experienced a dramatic downturn in recent days. Over the last 5 trading sessions, the Nasdaq 100 index has plunged by more than 10%. This sharp decline has officially pushed the index into bear market territory, which is defined as a drop of at least 20% from its most recent peak. Such a swift and severe correction has understandably rattled investors, sparking fear and uncertainty across the market. But while panic can spread like wildfire, it's vital to maintain a level-headed and disciplined approach. In moments when Wall Street becomes irrational, staying rational becomes your greatest asset. Instead of reacting emotionally or making impulsive trading decisions, investors should take this opportunity to refocus on their long-term financial objectives. It's easy to get caught up in the noise and volatility of short-term market swings, but wealth is built over decades, not days. The best course of action is to widen your investment horizon, avoid knee-jerk reactions, and remain laser-focused on long-term value creation. Now is not the time to sell in a frenzy or try to time the market perfectly. Rather, it's a strategic moment to consider high-quality companies that are trading at discounted valuations due to the broader market correction. So where should investors look when the market pulls back this sharply? If you're fortunate enough to have cash on the sidelines, this downturn can be viewed not as a setback, but as a rare buying opportunity. In particular, there are 3 standout companies worth considering for long-term investors who want to hold through the ups and downs of the economic cycle. Let's dive into these picks, starting with a company that operates outside the United States and offers insulation from recent tariff concerns. Coupang is a leading e-commerce business with its core operations based in South Korea and limited exposure in Taiwan. While the company is listed on a United States exchange, it does not conduct any business within the United States itself. This is an important distinction because it means Coupang is largely shielded from some of the latest geopolitical and trade tensions, especially those related to tariffs. Recently, South Korea was hit with tariffs on exports to the United States. However, these tariffs do not apply to Coupang, as the company's business model revolves around importing goods into South Korea rather than exporting them. Of course, an economic slowdown in South Korea could still pose challenges, particularly if consumer spending weakens. But Coupang's financial position and business fundamentals suggest it is well equipped to withstand such headwinds. As of the end of 2024, Coupang held nearly $6 billion in cash on its balance sheet and had minimal debt obligations. That kind of financial flexibility is invaluable during uncertain times. In addition, Coupang generated $1 billion in free cash flow last year, further demonstrating its ability to sustain operations without relying on external financing. When examining the company's performance, it's important to look beyond just revenue and focus on gross profit, which provides a clearer picture of the business due to the nature of its accounting. In the fourth quarter of 2024, Coupang's gross profit grew by 29% year over year when excluding one-time gains and acquisitions. Looking ahead, company leadership believes it can eventually reach a 10% profit margin once it reduces its heavy reinvestment in growth initiatives. At that margin, the company would earn roughly $3 billion in profit based on today's revenue levels, and that figure could grow substantially in the future. The company's current valuation stands at approximately $36 billion in market capitalization. This places it at just over 10 times those forward-looking earnings estimates, which is extremely attractive for long-term investors seeking value. In short, Coupang appears to be a deeply undervalued stock for those willing to buy and hold through short-term market noise. Moving on to another major player in the e-commerce space, we turn our attention to Amazon. As the largest online marketplace in the United States, Amazon sources a significant portion of its inventory from countries in Asia, many of which are now facing increased export tariffs. This could put some pressure on Amazon's supply chain and financial performance in the year 2025. However, the company is built to weather storms like this, and its diversified business model makes it uniquely resilient in the face of short-term headwinds. It's also important to understand the structure of Amazon's core e-commerce operation. Most of the products sold on its platform are not offered directly by Amazon itself, but by third-party sellers. This distinction matters because it reduces Amazon's direct exposure to cost increases from tariffs. If these independent sellers experience difficulties, whether due to bankruptcy or needing to restructure their supply chains, Amazon is not financially responsible for absorbing those losses. Its role is more like a facilitator or marketplace operator, which helps limit its downside. Additionally, Amazon has invested heavily in infrastructure within the United States. This gives it a level of domestic self-sufficiency that some of its peers, such as Apple, cannot match. Many technology firms have major manufacturing or capital investments in countries like China, which can be highly vulnerable during geopolitical conflicts or economic slowdowns. Amazon's more localized approach to its capital spending gives it greater control and flexibility in challenging environments. Beyond e-commerce, Amazon also enjoys powerful growth engines in the form of advertising, subscription services, and cloud computing. The cloud division, Amazon Web Services, continues to benefit from the surge in demand for artificial intelligence solutions. This segment is expected to grow steadily throughout the year, regardless of short-term economic pressures. Although advertising revenue may decline if consumer sentiment weakens, it remains one of the most profitable arms of the business over the long term. Currently, Amazon's stock has fallen to a market capitalization of approximately $1,870 billion. The forward price-to-earnings ratio has slipped below 28, one of the lowest levels in the company's recent history. This valuation suggests that investors are being offered a rare opportunity to acquire shares of a dominant technology company at a significant discount. Even if the numbers look weak in the short term, Amazon remains a foundational stock for any long-term portfolio. Finally, let's discuss a financial institution that tends to be lumped in with traditional lenders and credit card issuers, but is actually in a much stronger position than many of its peers. When the economy is booming, these businesses thrive as loans perform well and consumer spending is strong. However, during a recession, the picture changes dramatically. Losses increase, defaults rise, and earnings can take a sharp hit. American Express is often viewed through this lens as it is one of the largest credit card issuers in the country. But what sets it apart is its premium customer base. The company primarily serves affluent individuals with high credit scores, people who tend to be more financially stable even during economic downturns. During the inflationary period of 2022 and 2023, American Express managed to keep its loan loss rates at roughly 2%, which is on par with or even better than levels seen before the global health crisis. This kind of consistency is a testament to the quality of its customer base and risk management practices. Even if a recession does materialize, American Express has a strong enough balance sheet to absorb the impact. And based on past performance, it is likely to recover more quickly and more strongly than many of its competitors. As of now, shares of American Express are trading nearly 30% below their previous all-time highs. This decline appears to be a case where a high-quality company is being unfairly sold off alongside weaker peers. With a forward price-to-earnings ratio of just 15, American Express stock represents a compelling value for investors seeking a strong, stable business to add to their portfolio. It combines conservative financial management, a resilient customer base, and a proven track record of navigating economic cycles, all of which position it well for future growth. While market downturns are never easy to endure, they do provide long-term investors with a golden opportunity. Stocks like Coupang, Amazon, and American Express are trading at valuations that could look like bargains in hindsight. If you can stay calm while others are panicking and remain committed to your long-term goals, now might be one of the best times to invest for your future. In the end, the recent stock market downturn has pushed the Nasdaq 100 into bear market territory, prompting panic among some investors, but for those with a long-term mindset, it offers a rare buying opportunity. Coupang stands out as a resilient e-commerce company insulated from United States tariffs due to its South Korea-focused operations and a strong financial position, including nearly $6 billion in cash and $1 billion in free cash flow. Amazon, though more exposed to tariffs, benefits from a diversified business model with strong segments like cloud computing and advertising, and its current valuation appears attractive for long-term investors. Meanwhile, American Express, despite being categorized with other lenders, is uniquely positioned due to its affluent customer base and stable credit performance, making its recent stock price drop a potential buying opportunity. These three companies, Coupang, Amazon, and American Express, each offer strong fundamentals and long-term potential for investors looking to capitalize on the market dip. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.